Hi everyone! In this video, we will discuss important tax consequences when you sell your rental property. When you sell your property, you will have to pay tax on any gain or profit you earn or realize unless you do a like-kind exchange. If you lose money, you'll be able to deduct the loss subject to important limitations, which we will cover later. Whether you have a gain or loss depends on your adjusted basis in the property. Your basis changes over time to reflect the true amount of your investment. The new basis is called the adjusted basis because it reflects adjustments from your starting basis. Reduction in basis. Each year, you must subtract from the property's basis of the amount of depreciation allowed for the property. This is true regardless of whether you actually claimed any depreciation on your tax return. If you hold on to your property for the full recovery period, 27.5 years for residential rental property, your adjusted basis will be reduced to zero and there will be nothing left to depreciate. Your starting basis in property must also be reduced by any items that represent a return of your cost. These include the amount of any insurance or other payment you receive as a result of a casualty or theft loss, any deductible casualty loss not covered by insurance. Increase in basis. You must increase the basis of any property by the cost of any additions or improvements, amounts spent to restore property after it is damaged or lost due to theft, fire, flood, storm, or other casualty. In addition, assessments for items that tend to increase the value of your property, such as streets and sidewalks, must be added to its basis. When you sell your rental property, your gain or loss for tax purposes is determined by subtracting its adjusted basis on the date of sale from the sales price, plus sales expenses such as real estate commissions. So for example, Betty bought a small apartment building in January 2013 and sold it for $300,000 in December 2018. Her starting basis was $200,000. This chart shows her adjusted basis for each year. As you can see, when you sell your property, you effectively give back the depreciation deductions you took on it. Since they reduce your adjusted basis, they increase your taxable gain. So Betty's taxable gain was increased by the $43,027 in depreciation deductions she took. And Betty calculates her taxable gain on the property by subtracting her adjusted basis from the sales price, $300,000 minus $170,000 equals $130,000. The amount of your gain attributable to the depreciation deductions you took in prior years is taxed at a single 25% rate. However, if your top tax rate is below 25%, the lower rate applies. So Betty, for example, would have to pay a 25% tax on the $43,027 in depreciation deduction she received. The remaining gain on the sale is taxed at capital gains rates for 2017. The gain must also be added to Betty's net investment income and her adjusted gross income. This could make her subject to the 3.8% net investment income tax. You can't avoid this result by failing to take depreciation deductions each year. The IRS will treat you as if you had taken the depreciation and reduce your adjusted basis accordingly. Thus, you'll end up paying tax on depreciation deductions you never claimed. In a like-kind exchange, also called a Section 1031 exchange, you can defer paying taxes upon the sale of property by swapping your property for similar property owned by someone else. The Tax Cuts and Jobs Act eliminated like-kind exchanges for personal property after 2017. However, they remain available for real property. The great tax advantage of a like-kind exchange is that the property you receive in the exchange is treated as if it were a continuation of the property you gave up. The result is that you postpone the recognition or taxation of gain by shifting the basis of old property to the new property. So you defer paying taxes on any profit you would have received and own new property instead. Such deferral applies not only to regular capital gains taxes, but to the 3.8% net investment income tax as well. You may only exchange property for other similar property called like-kind property by the IRS. Like-kind properties have the same nature or character even if they differ in grade or quality. All real estate owned for investment or business use in the United States is considered to be like-kind with all other such real estate in the United States, no matter the type or location. So, for example, an apartment building in New York is like-kind to an office building in California. Now, if you keep exchanging your property for property worth at least as much as yours, you'll never recognize any gain on which you must pay tax. However, sooner or later, you'll probably want to sell the replacement property for cash, not exchange it for another property. When this occurs, the original deferred gain plus any additional gain realized since the purchase of the replacement property is subject to tax. For this reason, a like-kind exchange is tax-deferred, not tax-free. However, if you convert the last property you exchange into your personal residence, you can permanently exclude up to $500,000 of your gain from its sale. You must own the property for at least 5 years and live in it for at least 2 years to qualify for this exclusion. Let's assume that Betty rents out her house for all of 2013, 2014, and 2015. On April 15, 2016, she moves into the house and uses it as her personal residence. She can sell the property any time after April 14, 2018, which is after 5 years of ownership and living there for 2 years, and pay no tax at all on up to $500,000 of her gain because she is a married taxpayer filing jointly. The exclusion is only $250,000 for single taxpayers. In practice, it's rarely the case that two people want to swap their properties with each other. Instead, one of the property owners usually wants cash for his or her property, not a swap. This transaction can still be structured as a like-kind exchange. This is often done with the help of a third party called a qualified intermediary, or QI, in the business of facilitating like-kind exchanges. There are strict time limits on such delayed exchanges. You must identify the replacement property for your property within 45 days of its sale, and your replacement property purchase must be completed within 180 days of the initial sale. Because of these time limits, it's a good idea to have a replacement property lined up before you sell your property. You may be familiar with the Home Sale Exclusion, which allows individuals who sell their principal home to exclude from their taxable income up to $250,000 of the gain from the sale, or up to $500,000 if the sellers are a married couple who file a joint return. The exclusion applies not only to regular income tax, but to the 3.8% net investment income tax as well. Did you know that this valuable exclusion can be used for rental property too? To qualify for the $250,000 or $500,000 home sale exclusion, you or your spouse must own and occupy a home as your principal residence for at least 2 of the 5 years before you sell it. This means that the home may not be a rental property during those 2 years. However, you don't have to be living in the house at the time you sell it. Your 2 years of ownership and use may occur any time during the 5 years before the date of the sale. This means, for example, that you can move out of the house for up to 3 years and still qualify for the exclusion, per Internal Revenue Code Section 121A. This rule has a very practical application. It means you may rent out your home for up to 3 years prior to the sale and still qualify for the exclusion. Be sure to keep track of this time period and sell the house before it runs out. There is an important limit on the $250,000 or $500,000 exclusion. It does not apply to any depreciation deductions taken on the property after May 6, 1997. You must reduce your applicable exclusion by the total amount of depreciation you are entitled to take during these years. That is, you must include the amount as ordinary income on your tax return. However, starting in 2009, the tax law limits the $250,000 or $500,000 exclusion for taxpayers who initially used their home as a rental, vacation home, or for any other use than as a principal residence, aka non-qualifying use. The amount of gain eligible for the applicable exclusion is reduced pro rata based on how many years after 2008 the home was used other than as taxpayers' principal residence. The effect is to reduce the exclusions for landlords who converts a rental home into their personal residence. Let's do an example. Timmy, a single taxpayer, buys a home on March 1st, 2014 for $500,000 and rents it out for the next 2 years. During this time, he takes $10,000 in depreciation deductions. He evicts his tenants and moves into the home on March 1st, 2016, making it his personal residence. Timmy sells the property for $650,000 on March 1st, 2019. Timmy owned the house for 5 years and had a $150,000 gain from the sale. However, because he used the home as a rental for 2 years before he converted it into his residence, 40% of his total use of the property during the 5 years he owned was a non-qualifying use. His $250,000 tax exclusion must be reduced by 40% or $100,000. Thus, he qualifies for a $150,000 tax exclusion, but his exclusion of gain from the sale is limited to $140,000 because he must recapture his $10,000 in depreciation deductions. This reduction in the $250,000 or $500,000 exclusion can only occur if the home was used as a rental or other non-qualifying use before it became the taxpayer's principal residence. Rental or other use of the home after it was used as a principal residence do not constitute a non-qualified use and thus do not reduce exclusion. This rule applies only to non-qualifying uses occurring during 2009 and later. Uses before 2009 are not counted and do not reduce the amount of gain eligible for the applicable exclusion. You must report depreciation on IRS Form 4562, Depreciation and Amortization, including information on listed property. Carry over the amount of your depreciation to your Schedule E and subtract it from your gross rental income along with your other rental expenses. Be sure to keep all the documents you have showing the cost of your depreciable assets. This includes your real property purchase agreement, the settlement statement and closing statement you received from the escrow company when your property purchase is completed, canceled checks, bank records of payment, and receipts for all the expenses you paid for the purchase. Receipts and canceled checks for all improvements you make to the property and property tax bills. If you use cost aggregation, you need evidence of the personal property that was included with your purchase and its age. This includes carpeting, stove, refrigerator, dishwasher, drapes, and other window coverings, washers, and dryers. You can include this information in your purchase agreement or a separate statement signed by the seller.